Hey guys, thanks for checking out this week's FinPrep Trading and Investment video newsletter. So for the SPY here, we had a gap up on Monday morning outside of that down channel, the upper end anyways, but did close below it by the end of Tuesday and drifted down for the rest of the week. What's interesting here is actually that trend line we drew on the fast stochastics did function as resistance for that measure of price momentum essentially. And then the corresponding fall through on price was interesting play out. So the opportunity really for us to anyways to look at acquiring short-term long down at the oversold condition may end up playing out should this continue to coil nicely. And shout out to Day Trader Rockstar on YouTube for kind of identifying this pattern, and he has plenty of broadcasts on that, so feel free to check him out. Good stuff. So for SPY though, we look at similarly with the small caps in terms of IWM, this is Russell 2000 ETF, did lose a pretty significant level here at 120 as well as 118-ish. So as well as this trend line of this basically bullish up channel stretching back to March of this year. So having lost that, should it not regain and kind of regather its momentum, it kind of does send a signal of possible, a cessation temporarily anyways of risk on sentiment. Insofar as the small caps have been an outperformer. So here's just a relative, again, year-to-date price comparison of your major U.S. equity ETFs, so SPY, Dow, NASDAQ, and then in particular we want to pay attention to the small caps Russell as well as the mid caps, so you could see essentially the percentage gains on a year-to-date basis and through summer was the greatest within kind of that riskier segment in terms of the mid caps and small caps. So having now seen them sell off quite sharply here as we kind of approach this portion of the year is interesting. It kind of begs the question of, are we beginning to lose a bit of that mojo in terms of risk on sentiment? If so, do we see further downside beyond the 210, perhaps a 207 or 204 on the SPY? So we can't rule that out. And if that were to transpire, the question is, right, it's typically a flight to perceived safety, and that generally being U.S. government bonds. So with TLT, we've been checking this out for quite some time. We did kind of have that nasty sell-off beginning in the beginning of September with that rally back to that trend line extending into June of 2015. And then lost it quite quickly here. So price being currently below the 250-day moving average as well as flipping to the weekly chart, the 50-week moving average. So if Treasuries aren't to regain their, right, we would look for Treasuries to regain sort of a nice bounce here on this lower trend line. Not certain that it's going to happen. Things are looking pretty tepid and not really full of strength. So perhaps it would take a particularly nasty shock to the stock market to get TLT to get kind of a lift. But it is interesting. If you're not, without being in stocks, where can you run, right? In terms of the traditional go-to would be your government bonds. And as things are looking right now, losing this lower trend line would then, of course, open the door to about 127 on TLT. And it would be interesting to see how folks react if that were to happen. In terms of the dollar index, we did get that turnaround we were looking for at about 25.70. It came a bit early on, looks like Tuesday, a high of 25.62, and turned around. So how long this kind of respite and this pretty significant rise we had off of the Jackson Hole lows we were talking about a few months ago, about that 25.24 level, which extended back for quite some time as a previous point of bounces, etc. So how long does this sell-off continue, or is it just a break in this upward trend in the dollar? We shall see. Perhaps it finds support around this 20-day moving average and a little bit of a shelf support in there at like 25.25. Remains to be seen, but definitely a bit of a breather in the dollar is warranted here. We were looking for that, and it did end up showing up last week. So good stuff there. That would then play through to metals typically. So metals, again, here's GLD tracking gold price chopping around a lot around that 200-day moving average. You got the 20 finally cusping in under below, which could be support. But again, price still below that lower end of the prior price channel, which was demonstrating that gold was ascending all year. Similarly with silver, we have a pretty tight price consolidation, potentially bearish, but same story, and price being below its lower prior price channel. A little bit more of a wedge here, kind of blown out as silver is more volatile to the price of gold, extending back to the beginning of the year. So metals may get a bit of relief if dollar continues to slide a bit, and for that, of course, we pay particular attention given the strong correlation. We pay particular attention to the Japanese yen. So again, the FXY slip in here. So had a bit of a fake out above the 9 EMA, but still price being pushed down or capped down by the 9 EMA currently strong showing on Friday. So we'll see what makes of that. But in general, you're out of that strong price channel and then drifting lower with your shorter term moving averages acting as support for the most part. So interesting stuff there. On a longer term view, we're looking at the copper ETF JJC. This is pretty cool setup here in terms of again, similar. Remember with that GLD chart, we had that triangle, and then the breakdown had 4 points. This, I guess you can argue, has 5 kind of waves within the triangle, so to speak. So, you had your just various surges, and so particularly at this trend line here, where we had our last 2 surges off of that general zone, we then had a shot actually last week, regrettably, for a very strong long, and through Friday's close here at the upper end of this trend line. So of pullback could be certainly warranted here, given it's oversold. It's moved quite far, quite fast in terms of 1 week. But from the longer term perspective, flipping to the weekly chart, copper's had a rough slide here since peaking out in 2011, early 2011, along with I believe it was gold or silver in particular, around that time frame, anyways, that year certainly. And sliding quite disastrously. So from about over $4 a pound, and then putting in currently a low of around 2. This considerable consolidation over the period of nearly a year, arguably a year, could prove to be a base if copper in the long run ends up forming price above essentially what is resistance, and a pattern such as a wedge could be precisely that platform. So and then of course on the other hand, given where you are, a breakdown negates that scenario. But again, it's the fate of the commodities probably to be tied quite closely with the dollar. So just looking back on the dollar, stretching back to about 2015, you are not quite at the upper end of the price range. You're certainly off the lows and probably more than halfway towards the top. So there could be further weakness ahead for the commodities, or so we'll stay tuned for that piece. All right, guys. A lot of ground to cover this week, so thanks for bearing with us, and we'll talk to you next week.